Hi, everyone. I'm Rita Garwood, editor-in-chief of Monitor. Joining me on the podcast today are Joe Turner and Todd Beaver. Joe, can you tell us a little bit about yourself?
Absolutely. Rita, it's a pleasure to be on with you here today. Joe Turner, I'm the Senior Vice President of Strategic Markets for First Citizens Bank within our Equipment Finance Group. Been with the bank for 10 years now and about a year into this particular exercise.
Thanks. And Todd, how about you?
Thanks, Rita. Also glad to be here today. I am the sales and business development leader for the healthcare equipment finance segment at First Citizens Bank.
And that brings me to my first question. So First Citizens has launched a new healthcare equipment finance vertical. Joe, why did the bank decide to lean into healthcare equipment finance while others were pulling back after COVID? And why now? What makes this market, what market need did your team see that others may have missed here?
Sure. A lot in there. So we're 18 months into this particular launch, right? And we took our time. We were pretty methodical about where we were going to enter, who we were going to enter with, what we wanted to bring to the market, et cetera. But just to go back a little bit, First Citizens Bank has been around for over 125 years, right? For those who aren't familiar with us, super regional, based in the Carolinas, but our business covers the entire nation. And across that footprint, across the long, rich history of the bank, we've had a lot of healthcare experience, right? A lot of physicians' practices, a lot of professionals, et cetera, extending to hospitals through our footprint, et cetera. And it's been a part of the bank's core DNA and expertise since really inception, right? The bank acquired CIT, which is where our equipment finance business got into the fold. CIT has had, and now under First Citizens still has, deep kind of commercial banking, healthcare solutions for large office buildings and those kinds of larger investments, but there was a gap, right? And with kind of the rich equipment finance expertise and history that we had in the business and the bank's familiarity with healthcare, we recognized there's an obvious gap in our solutions that we were bringing to the market. So we recognized a lot of the core capabilities that we had across our equipment finance business could easily, with the right expertise, be brought to the healthcare market. And there's several reasons why we did that for our own business. Some portfolio diversification elements. There are some concentration issues that we needed to add a stable, diversified base to avoid, and then just a broader, more stable basis for growth in the future that'll be accretive to our kind of inherent risk profile. But in particular, as we thought about getting into healthcare at the time that we did, not only was it the right time for the bank and our business, but in the market as well, there was certainly an opportunity, right? What we saw was across large established lenders in the space, both in their equipment finance units and outside of their equipment finance units, folks were really struggling coming out of COVID because hospitals had runaway kind of expense issues, right? And their profitability was suffering. At the same time, a lot of elective procedures where they made a lot of money had come back. So folks that had large portfolios, that had been in this space, that were incumbents, were, right or wrong, right? They were reacting to what was going on in their own portfolio. A lot of them had bank-wide downgrades to healthcare. And certainly if they didn't do that, they had certain biases that would start to creep up and good opportunities that would otherwise be bankable because folks were burdened by a portfolio that wasn't performing exactly or had some risk in it. A lot of those good opportunities were not getting met, right? So we saw an opportunity to get in there with a fresh and sober look, fully aware of we were entering the market at a time where there was a little bit of challenge. But just it all lined up, right? And the bank is naturally, because of the nature of our family, leadership and history and ownership structure, we are naturally long-term thinkers too. So we weren't going to let that particular moment either get in the way and distract from what ultimately we needed to do for the long term for the benefit of our business.
Thanks for explaining all of that. So, Joe, what does the new healthcare equipment finance vertical aim to do differently from traditional bank programs? And how does the bank's perspective influence that approach?
Sure. So the bank is really focused on relationships, right? Or relationship-based, client-centric, long-term in thinking and orientation. And that allows us to really show up for the long term for our partners. So there's a number of ways in which we have innovated, have looked for solutions, have delivered those solutions. And I can point to a couple of quick examples, but people are everything, right? In this business, in any business, and Todd Beaver, who we've got on the line with us here today, right, is who we selected to help us get into the healthcare space, and not just because of his experience, but because in particular, his strategic thinking, right, and his solutioning and his ability and willingness to innovate. So it blends very, very naturally with our relationship based model at the bank and our long-term vision. And Todd had definitely, right, a really good understanding of the market and some of the gaps that were not being met. One quick example, right, and kind of the tagline that we got into this business with is, so obviously surgery centers, 50% plus of outpatient procedures now happen, or procedures happen in an outpatient setting through surgery centers, et cetera. And that shift is going to continue. Yet a lot of those transactions for vendor partners end up going through local banks, right? So kind of the tagline, the quick one-liner that we had going into this is we want to deliver a local bank appetite through a vendor program and vendor finance process that we knew really well. And Todd, with his experience and expertise and vision, really is helping us to do that 18 months in.
So, Joe, you mentioned the ambulatory surgery centers. They often have unique ownership structures and relationships. How do you underwrite those centers and other non-traditional provider settings without defaulting to like a no under a legacy bank rule?
Yep. So a quick out, right? A lot of folks would look at a surgery center and perhaps it's, owned in part by a development company, owned in part by a hospital, then owned in part by a collection of physicians, right? A lot of folks would look at that as a startup enterprise, right? And in reality, the hospital's not a startup, development company, it's not their first rodeo. And the physicians have existing stable practices and business that they can rely on as well, that a lot of that's going to get shifted. So from the outset, we don't look at that as a startup, right? Which is a disqualifier just on its face at a lot of other places and create some opportunities, of course. We look at it as kind of a de novo enterprise. And Todd can get into a lot more detail, of course, right? But the benefit and reality and practicality of chasing, let's say in this little example, 15 different physicians' personal guarantees on one of these transactions, because administratively burdensome and drives a lot of those opportunities outside of vendor finance models. It drives them to a local bank that, with that local bank's understanding of the practice and history and whatnot, they could get to a solution that doesn't require the same level in all circumstances, right, of personal guarantees and structuring, et cetera. So we were very cognizant about looking at that through the local bank lens. We leverage our partners and expertise across our bank and across our footprint to do that. And we're effectively delivering that today through a vendor finance model.
Great. Well, Joe has talked a lot so far. So Todd, over to you. Your background is in the manufacturer and captive world. How does that experience shape how you build programs for providers and OEMs inside a regulated bank?
Well, I think, and over a long history, but specific to healthcare, there's often a gap in language, a disconnect in understanding your partner and who they are. You have to realize that hospitals, med device, banks, they're all highly regulated just by different entities. So everybody's comfortable with the concept of regulation. But oftentimes nobody takes the time to understand what is the actual objective, what is the reasoning behind the structure that you are proposing. So there has to be someone with a background in both that can translate the language between the regulated bank and the regulated med device and make it an agreement that the regulated hospital will buy. On top of that, there has to be a willingness within the organization to actually learn and understand what drives your partner's business and how do you structure those transactions, those agreements, so that all parties involved will win. Instead of looking at it and say, well, the bank is protected, we're going to win. If you align with what the objectives are of your partner, then you can create a structure where everybody is cognizant of each party's regulation and each party is in the transaction to meet their required goals. So there's two parts: understanding, translating the needs, and a willingness to participate that defines a true partnership.
So, Todd, when we met to start planning this podcast, you emphasized linking where patients meet clinicians to how providers acquire capital equipment. And you mentioned innovating together with OEMs. What does that look like in financing terms?
Sure. The nuance of how providers acquire capital, what drives what they do, it really kind of comes from a fundamental understanding of what drives the success of an ambulatory surgery center, why the market is moving to the ambulatory surgery center. Initially, hospitals often challenged it. But when they discovered that doctors, patients, everybody wanted to move into the ambulatory surgery center because of a service level, you have to look at an organization and say, what is a true predictor of success? When a highly skilled surgeon is doing what they are doing, how can I structure an agreement that is a complete solution, providing consumables, equipment, services to that provider on the patient set that they're already going to operate on? It's just a matter of where they operate on them. And it creates ability, once you understand those dynamics and the gold standard of a surgeon saying, I'm going to move procedures from this location to this location, it becomes a lot easier to predict the success of that organization. When you add that on top of the fact that that's actually where the patients want to be, because what at a hospital would be a 9-hour process is now a 2-hour process. Every member of the market wants to move that to that location. And it simply becomes a matter of structuring the parts and, again, creating that partnership that predicts success and provides for the goals that everyone is seeking to achieve.
So, earlier this month, First Citizens announced a new financing program with Distal Motion. What about Distal Motion and its Dexter platform made this a fit for your program? And what hurdles did you need to solve to make the vendor finance model work?
First of all, Dexter is a really cool cutting edge technology. My compliments to them, huge investment in intellectual property, design, research. But they were intelligent enough to know that there is another soft tissue market, that robot in the market that truly does control the market. But it is a large system focused on complex procedures that take 2 to 4 hours. It's very expensive. It's very successful. Dexter realized that there was an opportunity to come in and drive a solution that was less invasive, but focused on some of those less acute procedures, and really kind of as a complement to the dominant robot in the market. So it's really understanding their logic, their research, why they were targeting what they were targeting. But it does not change the fact that they're a pre-commercial company. And the unique opportunity as a bank financing company was to accelerate that commercialization process for them. As they bring it into the U.S. market and they try to monetize, and they continue to do their research, but to help them make Dexter the acceptable or the primary clinical choice for those procedures was a unique opportunity for a lender to increase the quality or standard of living for patients that were undergoing a procedure. So that was really kind of a unique opportunity of understanding who they were and why they were coming to the market in the way they were.
So we've already talked about how many lenders had healthcare in general on watch lists. Todd, how do you balance prudence with responsiveness in a market like this? And what are the non-negotiables that you look for in an OEM or a provider partner?
Yeah, it really is. Can you have true conversations and be partners to understand what the goals are? there's no doubt that the complex legal structures of of the entities in ambulatory surgery center are, you have to dig through them and understand. So there's going to be a little bit of a longer timeline. You can't expect a response in 90 minutes or less on a multi-million-dollar transaction for a three-party entity. So it really kind of sets that understanding of who we're working for and with, and then really explaining the process to them and having a good foundation of what is the end goal here. And if we understand that the end goal is to provide the equipment that the clinician wants, the provider wants to treat his patients, there are multiple avenues to get to that. And really, once you can communicate that you're on the same level, that you understand the market dynamics that drive the success of this, you really limit it down to one or two factors that you need to cover down. And you can pretty quickly say, these are the 2 points that are going to be the sticking. We're either going to solve it structurally or somehow in the partnership. But it is that concept of partnership and doing vendor deals at a bank rather than bank deals at a vendor that drives that communication, that drives that success and balances those factors.
So I want to circle back to the ambulatory surgery centers again. Todd, you mentioned that in the past hospitals were kind of not in favor of them, but now they seem to be embracing them. What financing features or structures are most important to support that migration while keeping provider economics workable?
It is interesting. We often laugh that surgeons, when they are asking hospitals to buy things, act very differently when they are buying them for their own ambulatory surgery center. And it does make logical sense when, the most acute patients are still going to go to the hospital. You as a patient have to fit a profile that the surgeon says, we have a high probability of success of doing your procedure in the ambulatory surgery center. So from there's already a control to what is going into the surgery center, but it also has an impact into what type of equipment they buy, how often they buy it, what type of vehicles they use to finance that equipment. It is a lower cost model for them, and once hospitals sort of understood that it was a benefit to them to move those more predictable procedures to the ambulatory surgery center so that they could focus on the very acute cases that required their overhead, required their emergency services. It became a partnership that everyone kind of agreed to. They largely will use many of the same structures and financial vehicles. It's just a difference of underwriting a multi-billion-dollar hospital system versus a multi-million-dollar ambulatory surgery center. They want the transaction to look the same, their payment collections, their structures to be the same. But you do have to kind of walk them through the fact that you're not the hospital. We can structure things very similarly, but just as you negotiate or you participate in the hospital for access to their GPO contract, we do have some structural limitations. They typically do want to own the equipment and keep it for much longer than the hospital will. So that is kind of the basis of where you start and go from there.
So Joe, I want to shift back to you. What does a strong vendor program with First Citizens look like, from onboarding and credit philosophy to speed, documentation, and go-to-market enablement?
Yeah. So these days, right, speed, simplicity in a vendor space is a given, right? Certainly, if you're dealing with a highly sophisticated, $1 million MR purchase, right, you get a little bit of a different timeline than a point of sale financing. If someone's looking to buy a tractor and walk out that afternoon. But regardless, speed, simplicity across a vendor model is a given, right? These days, electronic documents, digital enablement throughout all parts of the process that we can integrate it are really table stakes type items. So more philosophically, right, about what makes a strong vendor program for us. Um, First off, right, we offer and we strive to offer a great, consistent product and service for all of our vendors, dealers, manufacturers, distributors alike, whether or not we have kind of a bedrock, $100 million plus type program, or we're just doing some steady flow, reliable business. We strive to offer kind of a great, consistent product there. But certainly those longer term strategic partnerships have always been and are today kind of the bedrock of our business, right? Someone that is willing to roll up their sleeves, right? Not think about accomplishing an objective this year, but building something that'll help achieve their business's objectives over 5, 10 years. And certainly some of the tenure of our active partners on our books speak to that long-term strategic alignment. But in simply put, right, we strive to be important to the folks that are important to us. And when we have a vendor, manufacturer, dealer, whoever it is, right, that's willing to rely on us, put their trust in us, right, we'll do the same. And there's very few limits, despite the regulatory environment, et cetera, of what we can't do and how creative we can get. And it really all comes back to the culture of our business, the culture of our bank. We've got a passion for our client success, right? And with a longer term perspective, we get excited to roll up our sleeves, right? Todd is absolutely giddy, right, when he's presented with a challenge that we haven't necessarily solved before, right? It's our pleasure and it's our honor to try to meet that need, to come up with a solution. And if you have the right partner and you're aligned with them and you're thinking in terms of 5, 10 years success and building something together, there's really, not to sound too, philosophical and whatnot, but there's really no limit to what we can do, despite if we're a regulated bank or not. There's lots of ways to put solutions in the market, and we get excited by the opportunity to do that for one of our partners.
I'm getting exciting just hearing about this. So can sense the enthusiasm from both of you. So as the healthcare equipment finance vertical, as you continue to build it out, what KPIs or milestones will tell you that it's on the right track?
Sure. Yeah, interesting to get Todd's view on this too. But of course, the volume, the originations, right? We have, milestones and objectives that to hit what I kind of laid out at the top of the podcast, right? Around the strategic objectives for our business. We're a pretty large participant in this space. We've got a sizable balance sheet. So to hit those objectives of diversification, of accretive risk profile of the portfolio, and the rest that I laid out, we have to do it at scale, right? Doing a quaint $50 million of healthcare business is not why we got into this. Again, long-term strategic thinkers, like we need to build something that is sizable to deliver those objectives. So certainly, volume and measured in the hundreds of millions is our primary KPI. And that takes a while to build, right? Not only if you win a partnership, you win a transaction, you win relationships, you build a pipeline, and that might not materialize overnight. But before that hundreds of $1 million volume KPI is met, there's a lot of positive indicators. And similar, to the Distal Motion Dexter press release, not everyone we work with, we go through those links and put out a press release for or whatnot. But along the way, as we sign up partners, we get folks bought in to not only the bank, our culture, our team, Todd, his team, and their vision for the market and our ability to provide solutions. Like those are certainly, key markers along the way. So partner acquisition, short of volume, is what I look at day to day. That gives me a lot of confidence that Todd and his team are doing exactly what we wanted them to do, and probably a little bit better than I would have expected 18 months in. Todd, would you add anything to that?
No, Rita, I laugh because I'm a healthcare equipment finance provider that happens to work in a bank. So I will often just say I'm a healthcare guy. I'm not a banker. So I will look at, am I partnering with equipment manufacturers, providers in a way that drives solutions that impact the standard of living for their patients? And that is probably can I drive a creative solution that impacts an individual's quality of life? And that has a tremendous meaning to me as I look at the solutions I build, the equipment partners we work with, the solutions we drive for a local ambulatory surgery center. Our goal is to make sure that ambulatory surgery center has the equipment they need to serve their patients now, tomorrow, and for the decades to come. And that fits with First Citizens' concept of relationship and long-term, both for the local ambulatory surgery center as well as our equipment manufacturing partner. Sustainable solutions that impact health standard of living. That's how I gauge our success.
That's great. We're just about out of time here. Any final thoughts from either of you?
No, just thankful to have the opportunity, Rita, and we appreciate it greatly. And I think the bank's doing a lot of good things, and folks might not associate First Citizens Bank in the equipment finance industry yet, but really good organization, and we're blessed to be a part of kind of the family and First Citizens and the rich legacy. And it's done a lot for our business and enhanced it in a lot of ways. And again, we hope to do it for years and years in the future with our long-term thinking. So appreciate the opportunity.
Definitely.
Thanks, Rita.
Thank you both.